Welcome back, everyone, to Vox Markets. My name is Paul Hill. On this special Christmas edition, I am delighted again to be able to speak to Jamie Constable of Singers, one of the UK's smartest capital markets experts. So welcome, Jamie.
Happy Christmas to you as well, Paul.
Yeah,
Go on. It's quite tricky feeling a bit in this. Are we smart at the moment kind of thing is the big question, isn't it, I think?
Well, we'll come on to that. We'll let the investors sort of decide by the end of it. But given the sort of the top level angst at the moment in terms of Omicron and tightening central bank policy, and also sort of like that red hot inflation really this side and the other, and then the other side of the Atlantic, what's your sort of view for equities as we look forward into 2022?
Well, I think what people forget is that interest rate rises per se, or tightening it, as it's more in the US because they're not raising rates yet, of course, are not necessarily bad for equities. You know, you need to remember they're not necessarily bad. Why are central banks tightening? Partly because inflation is elevated, and you're bang on over 6% in the US, over 5% in the UK, and let's be honest, their mandate's 2%. I mean, as we've spoken about before, they should have moved before now, and the Bank of England got themselves in an awful situation yesterday where they had to move, but they should have moved last time round, and then they wouldn't have had this problem this time round. So yes, I think rates are going up, but they won't raise rates if they're worried about growth. So rates go up because, okay, you've got inflation, but also they're happy with the growth scenario. So that's why rate rises aren't necessarily bad for equities. So as we saw, there's a little bit of a sell-off on tech overnight after on the US, but markets went up in the UK yesterday when they raised rates. The other point is everyone worries into the start of the rate rise cycle. When's it going to start? What's going to happen? But actually, you remove the uncertainty by starting it. What worries markets more than anything? Uncertainty. Uncertainty has been removed. It started somewhat coincidentally. You've got in the US now, futures are predicting 3 rate rises, 75 basis points in the US next year. And what are they predicting in the UK? Exactly the same, with the next rate rise in February. So everyone's sitting there going, okay, if that's what happens, that's kind of that. So that's a consensus now. People know that we've started the cycle, and now we can look at the data to see what happens next. So yeah, it started, and it's not necessarily bad for equities. That's the key.
What do you think in terms of the 10-year Treasury? And because I mean, at the moment, I saw expectations on Wall Street was such that the Fed was going to top out on its interest rate policy at roughly around about 2.3% was the last one, about 3 or 4 days.
2.5.
Yeah. Okay, 2.5, 2.25, something like that. But you've got your 10-year Treasury at 1.5. What am I missing? Is it basically the market think the Fed has made a policy error and we're going to see a recession? I mean, it just seems crazy that the 10-year is at less than 1.5, and you've got expectations in the city built in at sort of like 2.3%.
Yeah, I totally agree with you. I think I seem to remember we said this time last year, but I seem to think that my view is the US has to be above 2% by this time next year. The US 10-year has to be above 2%. And in the UK, you've got 0.74. And if we're talking about UK base rate going to 1% by the end of next year, it's not going to be 0.74. I think you almost have to add a whole 100 basis points to the UK 10 by this time next year to 1 3/4 or something like that. And that's got to happen. So if that money's coming out of bonds, where's that money going to go? Well, some I'm sure will be going into private equity. The US are opening up private equity to private investors, et cetera, but a chunk of that's going to come into equities. So again, the rate rises and those bond yields, it's not necessarily bad for equities. That money's going to come into equities. So yeah, bond yields have to rise.
And that's going to be bad for fixed income, isn't it? Fixed income investors could get hammered next year.
You do not want to be in bonds if that's what's going to happen. You really don't. Now, your point about are they making a policy mistake, that's the alternative view, of course, that it is transitory and not now broadly based, which was you have to think, you think back a month, Powell's change of view in the US is extraordinary. They've gone from transitory to we're virtually at full employment and it's a broadly based inflation that we expect to remain elevated for quite a while. Just complete, and we thought that anyway, let's be blunt. But they
what point would you sort of like say that your thesis in terms of sort of rising growth, etc., is wrong, because the yield curve is flattening. There's no two ways about it. Short end is rising on the interest rate outlook, but the long end's coming down, and it ain't too far off, as in, like, getting sort of, well, it's sort of like 2 or 3 year sort of, like, in terms of narrowing of that gap. I mean, it's definitely flattening anyway.
Well, I think that's the natural reaction to what they've announced. We've got to think back here. We've not had rate rises, and in the last rate rise cycle, it hardly happened. So almost you're thinking back pre the financial crisis for a proper rate rise cycle. So you're going to get natural reactions. That's what's going to happen. I would expect this yield curve, if we're right about what long yields are going to do, to steepen again in the short term. So again, that means you don't want to own long bonds. You want to be in equities. So yeah, I think it's more about this kind of, the market needs to get used to a rate rise cycle again. What does it mean for growth? Well, growth's not going to be the same in 2022 as it was in 2021. 2021 was the bounce back year. I've talked about the delta in the past, not the variant, but the delta as in the change, rate of change. Well, obviously the growth is going to be slower in 2022 and 2021, but the world's still going to be growing. I mean, China's probably going to start stimulating in 2022. There's different cycles going on through the world. Because of their property crisis finally coming home to roost, they've already cut the RRR once. They're going to cut interest rates. They'll be cutting, and we all know what China can do in terms of driving global growth. So you still got growth. I don't see.
Well, I'm with you. I still think, and also you've got the added sort of stimulus of, we've all been still saving shed load, and now we've got Omicron. We're going to be saving again. So we've got that bow of, sort of hundreds of billions of pounds, sort of like, and trillions of dollars sitting on the sidelines of consumers' wallets wanting to be spent, particularly on experiences. So just moving on to that, what is your sort of your take on the health of the consumer? Because consumer stocks, equities, if you're right, should do well next year, because they've been absolutely hammered over the last 6 months.
It's been carnage. It's been carnage. I went on holiday and came back and looked at the screens and went, my God.
Well, have you seen Boohoo? Have you seen Boohoo?
Let's come on to that in a minute. It is Boohoo, yeah, but we'll come on to that in a minute. But what do I think about the consumer stocks? I think you do have to be selective. I think that's where I see the value in the market. I see a lot of value in the market, and that's at the moment, because they've warned for various reasons, whether it's the online, it's the delta again. We talked about before about the building materials companies in terms of, will the consumer be spending so much this Christmas as last autumn? Probably not. What I suppose we missed to an extent was the delta on online 2021 on 2020. But on top of that, what really has hurt them is the short term, as Boohoo said, the freight costs and everything like that. And that is what the supply chain hasn't hit them so much. It's been time to delivery when you're delivering internationally, and freight costs.
And returns as well. Returns, they've had higher returns, haven't they?
Again, that's COVID though, isn't it? You go out and you buy that dress to go to the party doesn't happen, then I think people stop going out and people are quite cautious. So I think that's delivered it. But in that consumer space, what do I think? Leisure, I'm a little bit more cautious on the pubs and restaurants, because pubs and restaurants make their money, restaurants even more so in December, to tide them through to the March rent day, because January and February are normally very quiet. The publicly quoted companies are probably okay because they've got strong balance sheets. But if you're a private business and you don't make, and December's just disappeared, and I've heard some horror stories of and cancellations, all the big parties have been cancelled, that money's gone. You're not going to get it. So then how do you make it through to March? So we need to be a bit cautious more on the restaurant.
Will the government dip in their pockets again?
I think he will. He'll do something. Yeah. There'll be some selection, so that will happen. But again, there's value in there. And then there's companies like Fulham Shore, Francomanca, and the Real Greek, where they win either way, to be perfectly honest, because they've got a great online offer now from Francomanca. So if we're locked down, they get to deliver the pizzas. They've got a very strong balance sheet. If businesses go bust, the environment for their rollout gets even better. And if it doesn't, and if we don't lock down everything, they win anyway. But the share prices come back. So Fulham Shore's one I'd look at on that side.
And what do you think about sort of the Omicron sort of like variant, specifically in relation to the consumer, etc.? Because obviously we've reached a point almost of maximum fear, because people don't know what to expect, and therefore they're selling everything on the basis that it's worst case. But actually, it may not be as bad, and even if it is bad, then we're going to have tweaked vaccines coming through pretty soon. And certainly in 2 or 3 months' time.
Definitely, we'll get tweaked vaccines. The booster obviously works. I mean, and I'm not a scientist, biologist, but T cells are the key thing here, and the T cells remember what antibodies you need to produce, which is, I think, why the vaccine works so well. The booster works so well, because suddenly you get all the antibodies back in your system, which is why they want the people to have the antibodies. But I think the experience in South Africa, we have to look at that, where apparently it originated, Omicron. In the last week, hospitalization rates are down 91% versus their last COVID wave. Well, that means hardly anyone's going into hospital. Now, obviously, what we do have to be cautious on is it's happening so quickly. It's a really fast spike with Omicron because it's so transmissible. And if they're right, and it's doubling every 2 days, they said it was 200,000 on Monday last. Today, the 17th of December, that will have gone up to 200 to 400 on Wednesday, 800 today, 1.6 million on Sunday. Well, we'll know whether the hospitals can cope by Christmas.
And is this, sorry, the number you're quoting, is that South Africa or is that the UK?
That's back to UK, sorry, that's UK. So we'll know whether the hospitals in the UK can cope by Christmas, because with the lag, there'll be so many people having caught it that the hospitals will be in trouble. Now,
the number of infections like yesterday were 88,000.
Yes, but they can't test for more than a certain amount.
Right, okay.
So I think there's going to be massive underreporting. Let's be honest. If you tested positive on a flow test now, are you going to go and get a PCR and basically wipe out your Christmas? So I think there's a question of underreporting on that, to be perfectly honest, and the lag. But in terms, the number you need to look at is hospitalizations. So far, it hasn't gone up. It's stuck around the 7,500 at the moment. People in hospital.
Yeah.
It's not ramping in South Africa. It is going up, but it's not ramping like nowhere near the number of cases. You've got graphs like that. You've got one graph going like that, one going like that. So that's not doing that. So if we don't see that in the UK, come the new year, people are going to go, well, the hospitals can cope. So what happens to those retail, leisure? I mean, Christmas, summer 22 is on the beach we discussed before.
Yeah, travel stocks and leisure either way should win, don't they? Because effectively they've been sold off, and even if it is slightly worse than you suspect, then we're going to get the vaccines tweaked and the boosters and stuff like that. So they'll be done and dusted by spring. So we should have a monster summer, because everybody's going to be so annoyed having been locked up over Christmas again.
Whereas the only issue is that the waves move at different speeds around the market, around the world. But if this is such a rapid one, it doesn't. Everyone's going to get it quite rapidly. So as we just, the summer will happen. Yeah. And the rosy scenario is Omicron takes over, wipes out the other variants. Actually, it's not that. It's quite mild, so it's not as bad even as the flu. And then once Omicron's done the rounds, we're all okay. So so what happens then? Where should you be looking? Where I just said the value is. So yeah, I think you need to look at those stocks. So let's just do Boohoo as well while we're talking about it. Obviously, it's very disappointing what they've come out with. Maybe I was a bit early in saying buy it, but the long-term story, medium-term story is still intact. They reiterated the margins, which are significantly higher than people like ASOS make. They're already expanding overseas to do direct delivery from overseas distribution centres. It's not a supply issue here. The returns, why the returns happening? I think is it to do with a Chinese competitor? I don't think so. It's nothing to do with that. I think it's just consumers are very cautious at the moment. So,
yeah, I think from my read on it, because I listened to the actual the analyst call afterwards, it appears there's two things. One, because they're selling more sort of party dresses, and obviously that's gone into the UK, and because all those Christmas sort of like outfits have been cancelled, a lot of them have been returned. But also I think when you're selling a dress compared to a sort of like an all-in-one jumpsuit type of stuff, then it's more tailored to the individual. So you get the individuals buy 2 or 3 sizes and send back the ones they don't want. So you've got that because it's a higher price point. So I just think they need to address their proposition, their service proposition for higher priced items, and in terms of how much you can return. But they'll be able to. John Little, I think, having listened to him, sounds a really good guy. So I think he'll sort that out.
Yeah. It's obviously very disappointing, but I do think the long-term drivers are very much intact there.
Yeah, well, I hope you're right, because I've lost a shed load of money on it. So, like many other people. But the point is, I think the point is for investors, which is have a longer-term time horizon. That's all part of being sort of like investing in stocks, is that you can go through certain fallow periods. But as long as the sort of like the end game has not been, and the proposition has not been diminished, then you're happy to hold. It's just important. Don't trade on margin. Don't buy on sort of like, on debt, and therefore you have to sell. You have to become a distressed seller, so you can just work through it. And yes, it's painful, but frankly, that's part and parcel of what, you get higher returns in equities because you take the volatility, and a few of the even big caps like Boohoo can go through some bad. So I'm not happy, but frankly, it was much worse at the start of 2020.
I think, and people will feel maybe grumpy, a bit bad at the moment because of what we've seen over the past. The second half of 2021 has been a torrid period for equities, but that doesn't mean it's not the right place to be, as you just said. And when you sell something is when the reason why you got in has fundamentally changed. Boohoo, I don't think that is not what has happened. That is not what has happened. So you definitely stick with it. And another stock that sold off, I think you wanted a few little pointers for next year on this call is Volex, which is, as we've talked about, it's EV charging. Well, they're the world leader in that. Where's that going? The cables.
It does cables, doesn't it? Yeah.
Cables. It's white goods. That's not going away. That's going to keep.
But it's
going.
also healthcare, isn't it? They've moved the dial on the margin. They've moved up into pricier products where you need.
Well, they've always been in those. They've always been in health. They provide the cables and the wiring harnesses for the MRI systems, for example.
Yeah.
So there was a period where you couldn't get into the hospitals because to deliver them. But the demand, what the latest on that is, demand is increasing because people are having to build more hospitals because of maybe we get more pandemics, etc. So all the drivers are in the right place for Volex, but the share price, we talk about retailers and consumer being hit. Industrials have come back quite a long way as well. That price has come back from like high 400s to 325. Yeah. I mean, it's a great entry point here for Volex. So that's another one I'd point out really as one of.
I would just on sort of like my sort of like looking into 2022 just quickly. I mean, I at the start of this year, I sort of suggested to investors to run the slide rule over my 2 top picks, which was Equals, which is an e-payments platform, Forex, international payments, and Northbridge, which is basically crash-chick load banks, based on sort of secular tailwinds and long-term sort of like drivers. And both of them were sort of like say my top picks, done well this year, and still reasonably good, well priced. But frankly, I still think they could both of them could double over the next 18 months, 2 years. And just quickly on Equals, I mean, they're absolutely knocking the ball out of the park. They had a fantastic year-end trading update. I mean, they blew to pieces the broker forecast, but on the top line and they upped on the EBITDA, and they're making so much money that they can actually invest further for organic growth, which is what the top team are doing. So I would suggest, even though it's done well for 12 months, that could easily, and it's still reasonably valued. I mean, the whole space for e-payments is valued at roughly the sector at sort of like 5 to 6, well, nearly 6 times EV sales. And these on next year are still 2.3. And the tailwinds are just fabulous. But the point is, it's a platform, and therefore the incremental drop through rate. Unit economics is fabulous. And then it's actually, what's amazing when you turn and have a look at Treasury, which is the Northbridge big division, the key, the drop through rates for their rental business on the load banks is even higher than the 60%. I mean, they're about EBITDA drop-through rates are about 80%, and return on capital employed is over 20% on the load banks division, which is by far and away their biggest sector. They're getting rid of their oil, well, effectively their gas, the Tasman business at the moment. But when they do that and they have a clean, just to give the investors a feel, the secular drivers behind this are the adoption of data centers. You've got renewables and grid stability, because what the load bank does.
It's moving to the electric economy, isn't it?
Yeah, it is. Yeah, because basically what it does, a load bank, it tests all backup power supplies and uninterruptible power supplies. Because if you're a data center operator and you're taking power from the grid and it doesn't blow, and the grid is moving more towards wind and it doesn't shine, then you're going to lose power. And we've seen that across the states. We've seen it in the UK and stuff. So these data centers need their own backup power supplies, which need to be tested and commissioned using a load bank. So it's driving the number of load banks plus the number of tests that need to be done. And frankly, they're so busy that they can't get enough of these load banks. So they're increasing capacity by 50% at their factory out in Burton-on-Trent, and what that'll come on stream mid next year. And when that happens, that'll just be a sea change to the
step up in revenue.
Yeah. So again, it's done well this year. Both of them have done well, but I could see them doubling quite easily. Run
winners is always run your long-term winners is always a good one, isn't it?
Particularly where the fundamentals have only got stronger, and that's the sort of the key. It really is. So yeah. Have you got any others there, Jamie, hidden there?
Well, I mentioned Curtis Banks, obviously, before.
Oh, yes.
Curtis Banks. That's basically a beneficiary of rising interest rates. There's not many in the small cap, to be honest. But of course, the banks, what stocks went up yesterday in the UK? The banks, the financials, they went up because of steepening yield curve. All right, flattened a bit, but look, higher rates are good for the banks. So that's good. You don't have many banks amongst the small caps, of course.
Just on that Curtis Banks, what's quite interesting is that you're in good company there, because I know Christopher Mills of Harwood Capital he loves Curtis Banks, and also he started to top up his position in Northbridge as well, which says a lot, because that guy is one of the premier small and mid-cap investors across the world, never mind in the UK, and he knows his onions. But he loves asset managers and SIPs of riders and pensions. So Curtis Banks is right up there.
And you get a bit of tech thrown in with Curtis Banks as well, because they bought a technology business, which actually was a supplier to them, to be fair, technology solutions into the wealth management industry. And that now it supplies to external as well. And we all know there's one thing that pandemic has driven, which is accelerating digitization. So they've got that other side of the business as well. So yeah, rising interest rates, they're a beneficiary of that. There's a lag, of course, because it takes a while for that to come through, but it's great. If we're going to get 3 rate rises next year in the UK, that as the rates keep going up, what does that do for Curtis Banks? Should keep the share price moving up. So that's a good one. So I think that's probably about the one. So definitely have a look at those travel names, like On the Beach, the airlines. We all know who they are in the UK. EasyJet, Wizz, and I think some of those retailers. Some of these companies that have warned because of the pandemic. They haven't warned because their business model is broken. So that's the thing to bear in mind when you're looking at these.
That's really, I'd highlight to investors, that is absolutely crucial when you come to look at sort of like share price decreases. Is it transitory, really, and be honest, or is it actually something more sort of fundamental? And I'm with you. If it's just short term, then that's the real decide. That's the acid test.
It is.
Okay, so over the next month, then we're looking at. Are there any data points you sort of like? You're going to be looking at. You're going to be on a hawk like observation of hospitalizations. I see.
But hospitalizations is the key one, which I do a daily every day, and it's in my note. That's the key one, and keep an eye on South Africa, but also where else the wave's popping up. I think the US looks like it's quite going to be quite advanced, and of course in the US you have got that issue that vaccination rates, particularly in the southern states, are not as high as they should be. So you need to look at that. So obviously, yeah, we should know whether by the new year we should know whether the UK hospitals can cope or not. So that's the first thing. I suppose the other thing is, will we get a lockdown or not? But that's a short-term impact. That's more totally correlated with what we just talked about. The other point is the market is going to be watching closely now that we have started the tightening phase of the economic cycle on interest rates or reining back QE. What the data is. Are the central banks ahead of or behind the curve? That's going to be key. Now, what are the Bank of England is saying inflation is going to hit 6% in April, I think they think. Well, what you can see on the gas price, car prices, UK inflation is not coming back. So if the market gets worried that they're behind the curve, then it's probably worse for bonds than it is for equities again, to be perfectly honest. So that's not a worry, but we just need to keep an eye on that, because you could easily get wobbles in the market while this is happening. But then there's wobbles can provide opportunities. So that's the key.
What's your view on Bitcoin? Just quickly, are you a buyer or a seller?
I just don't think it. Let's say what people thought it was. People thought it was a store. It was an inflation protection and a store of value, right? If equities wobble, Bitcoin falls. Well, what is it then? It's just a gambling chip, as far as I see it. Now, don't get me wrong, blockchain has massive value, which is behind Bitcoin, and blockchain will be used everywhere in terms of which it effectively blockchain is a database and a way of managing data. And I see that one of the banks, was it JP Morgan or something, is kind of a blockchain-based basis for people to settle. But we've already got ways of settling things. So basically, what I'm saying is I don't really see any inherent value.
Yeah, well, you're very good. You're in very good company, because there's a guy called John Paulson who's a very, very astute hedge fund manager and investor out in the States, and he describes Bitcoin as a limited supply of nothing. Yeah. So,
it's a gambling chip, isn't it? It's a gambling chip. Yeah. And when you particularly in the US, you've got the online investors. They just treat it as another gambling chip. They'll go into a chat room and bid up, I don't know, GameStop or something, and they'll go into a chat room and bid up. You just have to, if you really want to analyze what's happening here, watch some of the videos of people who are advocates of Bitcoin or Dogcoin or whatever it might be. Watch the videos they put out and think about it from an analyst, from an investor's point of view, and then you'll go, it's just a pyramid scheme at the end of the day.
Yeah.
Anyway.
All right. Well, brilliant. Well, thanks very much for your time again, Jamie. Yeah. Insights. Have a great Christmas and New Year, and looking forward and chatting again, sort of mid-Jan.
Well, we know whether we're right or not, won't we, by then? So great time. Have a great Christmas yourself, and look after yourself, and good wishes to your family and everything. Cheers.